Hello everyone, this is Jordan. This video is being recorded on Saturday, June 15th, 2024. Thank you so much for tuning in. In this video, I'm going to talk about the best indicator for a recession and stock market downturn. Let me get right into it and make it quick. And that is the yield curve, and specifically when the yield curve steepens to above zero. So when the yield curve starts steepening towards zero and then it gets above zero, that's your indicator of a recession. And by that time, a downturn in the stock market will probably already have started. So here we have two different yield curves. We have the 10-year Treasury minus the 3-month Treasury. Here we have what's used most, the 10-year Treasury minus the 2-year Treasury. So we're basically looking at the difference between long-term rates and short-term rates. And so, again, 10-year minus the 3-month, 10-year minus the 2-year. And so when that spread goes below zero and is inverted, that's a warning sign, but it's only a warning sign, as we've seen in recent years and as has happened in the past. In 2006, 2007, that period it happened as well. So when it goes inverted, that's a warning signal. But it's after that, when it steepens, when the curve starts rising to zero and it goes above zero, that's when you get the stock market downturn and the recession. And you can see, I'll go with this chart because it has more history, a little bit more. Yeah, we can see this has a little bit more history. And we can see here, when it steepens and goes above zero, that's when you get the recession. Now, this is an inflationary period, so things can be a little bit trickier at that point. But anyway, after the first part of the double dip, you can see here steepens, recession. And since then, it's steepened before the recession. So steepens, goes above zero. And when it really has to make a clear surge above zero to indicate a recession. You can see that here at 2001, inverted here. Then it starts steepening. Then you have the recession here before the GFC, steepening, recession. Here, you can see this one came below zero. This one touched zero. But if you look at both, when it went above zero, that indicated the coming recession. So you can see where we are here and now. But this has been inverted for a record amount of time. Again, this is the 10-year minus the 2-year, 10-year minus the 3-month. These are not signaling an imminent threat of recession. Now, if they start in the next couple weeks or month, if they start moving up like this and like that, that's going to be a real concern. Again, if that happens and we make that move like that, even before we get to zero in both these cases, that's going to be a real concern. But we're not there yet. That's the short of it. So let's get into some more charts. Okay, so here we're looking at the stock market, the S&P 500. Fed funds rate, 2-year yield, and then this is the yield curve, the 10-year minus the 2-year. There's a lot going on here. I don't want to babble on too much, but the red lines are the market peaks. The blue is when the Fed cuts. Now, during this inflationary period here, it's a little bit different because during an inflationary period, once the inflation is under control, then the Fed can cut rates. And so that's immediately bullish for the market because the inflation hurts the market. The Fed has to hike, causes a recession. But then during the recession, the inflation comes under control. And then as soon as the Fed starts cutting or close to it, it's more immediately bullish. So we can see that here where Fed started cutting here, right here at this bottom, started cutting here, bottom not too long after that. 1974, same thing. So it's kind of different when you're in an inflationary period. When you're in a non-inflationary period or the other periods, when the Fed starts cutting, unless the economy is in a soft landing, that's really negative. So the soft landing, that's the one difference. Mid-80s soft landing, mid-90s soft landing. And then this was kind of if not for COVID, this would have been a soft landing. This was kind of a soft landing here where the Fed was supposed to hike quite a bit and they only hiked once and they decided they weren't going to hike for a while after that one hike. It's not foolproof in regards to the Fed starts cutting, it's bad for the market. But there's plenty of instances that being the case. Right here, also right here as well. So there's many examples of that. And with where we are here and now, this has been such a long move and a long run that I don't think we're setting up for a soft landing. It looks to me, again, let's look at where the yield curve is. This is, from a bird's eye view, this is really close to steepening above zero. So I think if the Fed has to start cutting at some point, and it's not necessarily going to be immediately, 3 months, 6 months, whenever, the market keeps going up for a little while longer, then if the Fed has to cut, it's setting up for, that's a significant top in the stock market, yield curve steep, that's your recession signal. Now, the other thing to look at, of course, is the 2-year yield, because the 2-year yield is a leading indicator. The Fed typically follows the 2-year yield. And if we look at the last 25 years or so, what's really interesting is the blue, again, the blue is when the Fed started cutting. Look how much the 2-year had gone down before the Fed started cutting. So you have this here. Remember, Trump was bitching about this, and he was right. I mean, he's bitching about the Fed and not cutting, and they should have cut sooner. You can see this here, judging from the decline in the 2-year. The same thing happened during the GFC, where the 2-year peaked here. This was a lower high. Then when it really started to fall, of course, they had to start cutting. Fed starts cutting here, I think at the beginning of 2001, but the 2-year peaked way over here. This is another case right here. So the Fed doesn't like to cut right away, but if we're looking at this here, this looks kind of toppy. And so if we see the 2-year fall over like this, that could be the first indication of the Fed getting really close to cutting. You see this 4.72, you see this get to 450, goes below here to the low fours. That could precede the yield curve steepening. So that's why I highlighted this. That's something to watch. Okay, now last thing, let's just keep in mind how gold and precious metals react very positively to weakness in the stock market. So this is a stock market, and between these blue lines, those are the bear markets in the stock market, at least during the times gold did really well. And down here, I've annotated what were the declines in the S&P. And you can see, again, this is a secular bull in gold. And you had 3 stock market declines during this period, 36%, 49%, 20%. Secular bull here, you had the twin 50% bear markets here and here. More recently, you haven't had anything that severe. You had the COVID crash. When was that? In here. But that was really short-lived. 20% decline here, and the Fed cut, and that started the 2018 to 2020 cyclical bull, ended with the COVID crash. This was a 27% decline right here. So we can clearly see here that gold performs its absolute best when you have bear markets in the stock market, when you have stock declines. So again, for gold to make this, for gold to double and essentially get to 5,000, you're going to need to see a decline in the stock market. And so in this video, we've talked about a few things that could be leading indicators of that. If the 2-year yield really starts to plunge, then the yield curve steepens. Those are going to be the things to watch for. One more thing, if you're worried about a 2008 repeat, let's go back and look at these declines and just think about the correlation. Okay, this one here, the gold stocks, they were correlated to the stock market during this decline, so they fell. But these ones here, this one and this one, gold and precious metals were negatively correlated. This one too, negatively correlated. This one, middle of the bull market, middle of the secular bull, okay, they were correlated. And this one, negatively correlated, and now they're positively correlated. They were positively correlated. So the 2008 repeat, again, I'll talk about this more in other videos, but we're not setting up for something like that. We're in a new secular bull market here with this breakout, and that will be confirmed when gold breaks out against the 60-40. Remember, those breakouts were here, 1972 and 2002. So those breakouts occurred around the cyclical bear markets in the stock market where precious metals were negatively correlated. So keep that all in mind. I know that was a lot to take in from this video. If you watched it all to the end, really appreciate it. Let me know what you think. Leave a comment. And hope you guys are having a great weekend, or hope you did if you're watching this on Monday. Thank you so much for tuning in. I'll talk to you guys again in the next video.